just like last week, the scheduled corporate news is going to come thick and fast, so we're going to skip the macroeconomics and dive straight in. Do note, however, that the Bank of England will make its latest decision on interest rates and quantitative easing on Thursday the 5th of August, while the latest American employment and wage growth numbers are due on Friday the 6th. And given the ongoing debate over inflation, the wage growth figure may be more important than the headline job additions and unemployment rate. However, we'll press on with the company news given the very full roster. Names which may be worthy of further research include the following, although do note that some of these dates could still be subject to change at short notice. HSBC and XP Power on Monday the 2nd of August. Standard Chartered, Fresnillo, Weir, Travis Perkins, Direct Line, IWG, Rotork, Greggs and Domino's Pizza on the 3rd. Legal & General and Hiscox on the 4th. Glencore, Rolls-Royce, Mondi, Meggitt, Convatec, Serco and Spirent on the 5th. And London Stock Exchange, Hikma and Conto Global on Friday the 6th of August. But the company which might just cause the biggest fuss in the week ahead is Taylor Wimpey. The house builder and FTSE 100 member is due to release its first half results on Wednesday the 4th of August. In some ways, the results could hardly be better timed. The shares are down by a fifth from their spring highs, despite an upbeat trading update in April, although they are nevertheless some 15% higher than they were a year ago. Now, we could say in some ways that the recent share price slide's a bit surprising. House prices rose 8.8% year on year in June, according to the Halifax, and the government launched its 95% mortgage guarantee scheme in the spring. Perhaps investors are nervous about the potential for a further lockdown hitting consumer confidence, and they may also be wondering what the termination of the stamp duty land tax holiday on the 30th of June could mean for housing demand. Now, as I noted earlier, Chief Executive Pete Redfern was pretty positive in the statement he put out alongside the annual general meeting in April. At the time, Mr Redfern flagged a higher reservation rate than a year ago at 1 per sales outlet per week, a lower cancellation rate than a year ago at just 14%, and an order book of £2.8 billion. Mr Redfern also reiterated Taylor Wimpey's long-term goal to reach an operating margin of 21 to 22%, and that's pretty much where margins peaked in 2017-18, before they halved to around 10% in 2020 as the pandemic hit home. When it comes to the first half numbers, the first items analysts and shareholders will look for are housing completions and average selling prices. Taylor Wimpey suggested it will complete between 85 and 90% of 2019's volumes, and that implies 14,000 dwellings compared to just around 9,800 last year. In the first half of 2020, as a benchmark, the firm completed on just 2,771 homes. Meanwhile, for the whole of last year, Taylor Wimpey's average selling price was £323,000. Margin-wise, management suggested cost inflation could be a little bit lower than last year's 2 to 3% run rate, and they'll be looking to mitigate that with efficiencies, although I'd imagine price increases will help too. The company currently expects an operating margin of 18.5% to 19% for this year as a whole, but note in the first half last year, Taylor Wimpey made a modest operating loss of £16 million owing to the pandemic. Analysts will be on the lookout for other cost developments as well. Taylor Wimpey set aside £125 million to cover fire safety improvements at apartment buildings built over the past 20 years, and that included buildings under 18 metres tall, when the rules only apply to those that are over 18 metres tall, so you could argue that they were more generous than perhaps they had to be. Shareholders will also look for more clarity on the Competition and Markets Authority's investigation into how leasehold dwellings were sold and the costs incurred by the buyers in terms of rousing ground rents. The regulator has given Taylor Wimpey scope to respond, but the CMA has threatened legal action unless the current terms of sale on ground rents are changed. Attention will then switch to the balance sheet. Taylor Wimpey raised £510 million from shareholders last year so it could buy land and set out its stall for future growth. The company ended last year with £715 million of net cash, and the forecast at the annual general meeting was that it would end this year with around £500 million of net cash in the bank. Finally, analysts and shareholders will look to dividends. Taylor Wimpey returned to the dividend list with a payment of 4.14 a share alongside its full year results for 2020. Management's long-term plans to pay out 7.5% of net assets a year as dividends, although the board's already said it won't make any more payments in calendar 2021. That does leave scope for declaring a dividend in early 2022 for fiscal 2021, alongside the full year results, and analysts do expect a payment of around 8p a share. They don't seem to expect the return of the special dividends, however, that were offered in 2013 through to 2018. As a final point, keep an eye on net assets and net asset value, partly because that's the driver of dividends, and partly because NAV per share is a key valuation metric. At the end of 2020, Taylor Wimpey had shareholders' funds or net assets of £4 billion, the equivalent of around 110 pence a share. As I sit here, Taylor Wimpey shares trade at a premium, around 1.4 times historic book or asset value per share. Generally, analysts argue house builders are cheap if they trade at 1 times book value or below, and are expensive if they trade at 2 times book value or above. Only you can decide for yourself whether you think this rule of thumb's any good or not, and if so, whether Taylor Wimpey shares are cheap or not. I hope that you and your families are in good health and good spirits. Thank you for listening, and I look forward to talking to you again next week.